In 2026, the average health insurance premium on the American Marketplace jumped by nearly 22%, the single largest one-year increase since the Affordable Care Act began. In some states, it was even worse. In Arkansas, benchmark premiums went up by 67%, the highest in the country. But here's the strange part. The thing that made your premium jump wasn't a new disease, a new law, or a hospital suddenly getting more expensive. It was a number on a page quietly expiring that almost nobody outside Washington was watching. Nearly 250 million Americans are facing higher out-of-pocket costs for health coverage this year, whether they get it through the marketplace, an employer, or Medicare. For people buying their own insurance, some are now paying 2, 3, even 10 times what they paid 12 months ago for the exact same plan from the exact same insurer covering the exact same doctors. Nothing about their health changed. Nothing about the hospital down the street changed. So what actually happened? The answer sits at the intersection of three things: a temporary subsidy that quietly expired, a market where a handful of hospital systems control the prices, and an insurance industry that has spent the last 2 years getting more profitable, not less, even while premiums for ordinary people were rising. This is the story of who pays, who profits, and why almost nobody saw the bill coming until it landed. If you're one of roughly 24 million Americans who buy insurance through the ACA Marketplace, freelancers, small business owners, early retirees, gig workers, this isn't an abstract policy story. It's the difference between affording your rent and not. Take a real example that's playing out across the country right now. A couple in their early 60s, earning around $85,000 a year combined. In 2025, thanks to a temporary subsidy boost, they paid about $7,000 for their health plan. In 2026, with that subsidy gone, the same plan could cost them over $22,000. That's not a typo. That's $15,000 extra dollars for the same coverage because of where a single number landed on a chart. To understand why, you need to go back to 2021. During the pandemic, Congress passed enhanced subsidies for ACA Marketplace plans, capping what any household, regardless of income, would have to pay for a benchmark health plan, generally at no more than 8.5% of their income. It eliminated something called the subsidy cliff, a hard cutoff where if you earned even $1 over 400% of the federal poverty line, you lost every cent of financial help instantly. For 5 years, that cliff didn't exist. Enrollment in the marketplace roughly doubled. Millions of middle-income Americans who previously couldn't afford coverage at all got in. Those enhanced subsidies were always temporary. They were extended once, but they expired for good at the end of 2025, and Congress did not renew them. Whether it should have is a genuine, ongoing political argument Democrats have generally pushed to extend the subsidies. Most Republicans have opposed extending them at the same cost, and neither side changes the basic math for the people caught in between. So as of January 1st, 2026, the subsidy cliff came back. And for a couple like the one we just described, it wasn't a gradual increase. It was a cliff because that's literally the word economists use for it. Here's the mechanism in plain terms. In 2026, if you're single and earn up to $62,600, or a family of 4 earning up to $128,600, you can qualify for a subsidy that shrinks your premium substantially. Earn $1 more than that, and the subsidy doesn't shrink. It disappears completely. You go from getting help to getting nothing overnight. This hits one group especially hard: people in their 50s and early 60s before they qualify for Medicare. Insurers are legally allowed to charge their oldest customers up to 3 times what a 25-year-old pays for the identical plan. So when an older couple crosses that income line and loses their subsidy, they're not just losing help on an average price plan. They're losing help on the single most expensive plan available. This is why the average out-of-pocket premium for marketplace enrollees jumped from $113 to $178 a month nationally in 2026, and that's the number after subsidies are applied. For the millions who lost their subsidy entirely, the real number is far higher. Now, here's where it gets more complicated, because the subsidy expiring is only half the story. Insurers set prices based on something called a medical loss ratio, the share of every premium dollar that actually goes toward paying medical claims. Regulators require it to stay around 80 to 85%. The rest covers overhead and profit. In the first quarter of 2026, United Health Group, the country's largest insurer, reported a medical loss ratio of 83.9%, lower than analysts expected, and raised its earnings guidance to more than $18 a share. Cigna posted over $1.5 billion in profit for the quarter with an even lower ratio, partly by exiting its most expensive lines of business, including announcing it will leave the ACA Marketplace entirely starting in 2027. To be fair to the industry, this isn't as simple as insurers gouging people. Some insurers actually lost money on ACA and Medicare Advantage plans in 2024 and 2025, with medical costs eating up to 96 cents of every premium dollar in some markets. Their response was to raise prices, exit unprofitable markets, and shed sicker, more expensive members. That's a rational business response. But it also means the people left behind in a shrinking and sicker risk pool are the ones absorbing the higher prices. A quick, honest caveat here: not every state's number means the same thing. Arkansas's 67% jump was amplified by a specific pricing strategy called silver loading insurers deliberately raising benchmark plan prices to increase subsidy amounts for lower income enrollees. So the headline number is real, but the mechanism behind it varies by state. Separately, hospital consolidation compounds the problem. In several of the states with the biggest premium spikes, a single hospital system controls 60 to 70% of beds in some metro areas. When one system dominates a region, insurers have far less leverage to negotiate lower rates, and those higher contracted rates flow directly into what you pay. Given all this, why don't people just walk away from marketplace coverage? Mostly because they don't have another option. Most marketplace buyers are self-employed, work part-time, or work for a small business that doesn't offer group coverage. Going uninsured means one bad diagnosis away from bankruptcy. That's part of why, even as premiums spiked, over 23 million people still selected or re-enrolled in marketplace coverage for 2026, only a 5% drop from the year before, despite the massive price increase. People aren't choosing this because it's affordable. They're choosing it because the alternative is worse. What's changed is how they're choosing. 40% of 2026 enrollees picked the cheapest, thinnest bronze tier of coverage, up from 30% the year before. Enrollment in mid-tier silver plans dropped from 56% to 43%. Translation: people are buying worse coverage because it's the only thing that still fits their budget. Here's the part that rarely makes headlines. This cliff doesn't just hit people evenly. Urban Institute modeling projects that subsidize marketplace enrollment could shrink from about 19 million people to roughly 12 million, and that nearly 5 million more Americans overall will become uninsured. And because ACA enrollees tend to have unpredictable, fluctuating incomes, freelance work, seasonal jobs, small business swings more than 2 million people are sitting right near that 400% line without knowing it. A good year of freelance income could accidentally push a family over the cliff, costing them their entire subsidy retroactively when they file taxes. This is the quiet, unglamorous mechanism at the center of the whole story. Not fraud, not a scandal. Just a hard mathematical line that turns a small income change into a five-figure financial event. As of mid-2026, this isn't fully settled. There have been bipartisan conversations in Congress about restoring some version of the enhanced subsidies, though most analysts see the odds of action as low. Meanwhile, insurers have already filed preliminary 2027 rates showing a median proposed increase of 15% on top of the increase you just saw. So the honest answer is nobody currently knows if 2026 was a one-year shock or the new normal. It depends on choices Congress hasn't finished making and on whether insurers and hospital systems keep consolidating in ways that reduce competition further. So who actually wins here? Large, diversified insurers who exited their least profitable markets are reporting stronger earnings and raising guidance. Hospital systems in consolidated markets retain significant pricing power. And healthier, younger enrollees who stayed in the market are, in the short term, subsidizing a smaller, sicker remaining pool less than before. Who loses? Middle-income people in their 50s and early 60s, right above the subsidy line, who now face the highest unsubsidized premiums in the system's history. People with unpredictable incomes who could cross that cliff without warning. And longer term, everyone, because when millions of people drop coverage, uncompensated care costs get passed on to hospitals and eventually back into the price of care for everyone else. This isn't a story with one villain. It's a policy choice allowed to expire by design, by Congress, colliding with a healthcare market that already has weak price competition in many regions, and an insurance system that responds to financial pressure the way any business does, by protecting its own margins first. If you're anywhere near that subsidy line, the practical lesson is this. Contributing more to a 401k, an IRA, or an SA-eligible plan can lower your counted income enough to stay under the cliff, a detail most people don't learn until it's too late. But the bigger question is one Congress hasn't answered. Should health coverage in the world's richest country depend on which side of an arbitrary income line you happen to fall on? If this kind of story is one you want to actually understand, not just feel angry about, subscribe, because we're going to keep pulling these threads apart, one hidden number at a time.